For AI to reach its full potential, it needs a purpose-built AI cloud platform with infrastructure and managed cloud services that are delivered in an efficient, automated, and highly performant way. Enter CoreWeave, the AI hyperscaler TM. Think of it like this. If AWS is a giant, all-you-can-eat buffet for cloud computing, CoreWeave is a high-end sushi bar that only serves AI workloads. Instead of offering general-purpose cloud computing like Amazon Web Services, it rents out super powerful GPUs, the high-performance chips AI models need to run, to companies like Meta, Microsoft, and AI startups. Key metrics: revenue growth 2022, $16 million. 2023, $229 million, a 1,346% year-over-year increase. 2024, $1.9 billion, a 737% year-over-year increase. And no, that's not a typo, haha. Profitability, still deep in the red. 2022 net loss, $31 million, 194% of revenue. 2023 net loss, $594 million, 259% of revenue. 2024 net loss, $863 million, 45% of revenue. Losses are still really large, but declining as a percentage of revenue. Name? Revenue model. 96% of revenue comes from long-term contracts, 2 to 5 years, providing high revenue visibility. Remaining performance obligations or contracted backlog, $15.1 billion, a 53% year-over-year increase. RPO is great because it gives companies grounds to show off the multi-year contracts they've secured with customers and provide additional confidence in the company's ability to deliver on revenue expectations. Instead of just looking at what's in the bank right now, RPO gives you the full picture of what's in the pipeline. There's a global shortage of high-end GPUs, and CoreWeave is one of the few players with access to them. As AI models grow larger and demand more compute, CoreWeave is cashing in by renting out the most valuable resource in AI right now, nvidia GPUs. CoreWeave buys GPUs from nvidia and rents them out at a markup. However, as more companies try to secure their own GPUs or build custom chips like OpenAI's rumored Stargate, will CoreWeave's model remain viable? CoreWeave's entire business depends on getting the newest and best GPUs from nvidia. If nvidia decides to prioritize other customers or sell directly to AI companies, CoreWeave may be in trouble. 96% of CoreWeave's revenue comes from multi-year, locked-in contracts, meaning customers pay whether they use the compute or not. At the same time, we're in a period where AI startups are raising billions and spending freely on compute. If AI funding cools off, will CoreWeave's backlog hold up? Or is there a risk that some of its long-term contracts don't actually get paid as companies go into difficulty? AWS, Google Cloud, and Azure could easily decide to focus more on AI compute and squeeze CoreWeave out. But right now they're spread too thin across multiple industries, while CoreWeave is 100% focused on AI. Right now, AI training and inference dominate demand. But can CoreWeave expand into other compute-heavy markets like high-frequency trading, biotech simulations, or video rendering? In 2024, Microsoft accounted for 62% of CoreWeave's revenue, highlighting a heavy reliance on a single customer. CoreWeave has $15 billion in long-term lease commitments tied to data centers, power contracts, and equipment rentals. These obligations don't appear as traditional debt on the balance sheet, but they function as long-term liabilities. Why this raises red flags? Similar to WeWork's model, CoreWeave is signing long-term leases to scale quickly while keeping the liabilities off the books. If AI compute demand weakens, CoreWeave could be locked into expensive, underutilized capacity. A shift to owning data centers would change the financial profile, requiring billions in CapEx instead of lease agreements. For now, investors need to treat this $15 billion in leases as hidden leverage. If market conditions shift, these commitments could become a major financial burden.